India has been on a path of significant deficit control compared to many other countries which have taken on continuing debt binges. At primary deficit, if you look at that glide path, it is now actually at reasonably similar levels to what it was in FY19 before the pandemic. You think about all of these new frontiers, the quantum of allocation still is very, very small. Given a significantly higher impact on futures, in some sense, it has also created some collateral damage for market participants like mutual funds, right? The number of companies which are now doing 100 million capex has almost doubled over the course of the last 3 years. So it is getting mainstreamed. It is our assessment that anywhere between 20 to 30 basis points of arbitrage fund potential returns, if everything else was same, can potentially get impacted because of STT. See, quite honestly, I don't think that we are not investing in AI because of capital. Compared to Bangladesh, compared to Vietnam, we seem to have a leg up over there, right? As well as with a depreciated currency, even more competitive compared to what it was before.
Hello, everyone, and welcome to our edition on Union Budget 2026. The Union Budget 2026 didn't chase big headlines, but it did raise some important macro questions around fiscal discipline, growth, and where India is placing its long-term bets. To unpack this through a macro and market lens, I am joined in by Mr. Harish Krishnan. Harish is the Chief Investment Officer, Equity at Aditya Birla Sun Life Mutual Fund. With over 2 decades of experience in asset management across domestic and international markets, he is known for his cycle-aware, data-driven approach to investing and is widely regarded as one of the more thoughtful voices in the industry. Thank you, Harish, for taking out time for us today and speaking to our investors.
Thank you so much. Always a pleasure.
Harish, my first question to you is, at a macro level, how would you categorize this budget? Do you think it was more pro-growth, pro-stability, or pro-credibility? And what does this tell you about where the policymakers think we are in the process of a structural cycle?
So I think it is a lot of these things. I don't think it can be classified only as pro-growth or pro-credibility or pro-stability. The reality, the way we think of it is that budget is becoming more and more a statement of accounts, with a lot more announcements happening outside of the budget, which focus on to the here and now from a growth perspective. So from that perspective, I think this is more tuned towards credibility more than anything else. Because if you look at it, there has been a very big divergence in terms of how India has acted over the course of the last 4 5 years post the pandemic compared to many, many other countries. Just to give you some of the contrast that we kind of observe. Is inflation. Inflation is trending significantly lower compared to most other developed world, wherein we've seen a very big spike up. The extent of deficits, again, India has been on a path of significant deficit control compared to many other countries which have taken on continuing debt binges to maintain their activity or to maintain their economic activity. Thirdly, if you look at, say, even currency, of course, the last 1 year, Indian currency has kind of depreciated, but by and large, if you were to look at the big currency moves over the course of the last 4 5 years, India has been an outlier in the form of very small, shallow currency moves all throughout. Again, last year, in response to the trade tariffs, that has been our way of kind of providing some support to the exporter channel. So, in many sense, the way we think about it is that India is acting more and more like a developed economy when it comes to macro stability, and therefore this credibility and this enhanced focus on fiscal prudence, I would think that contrast will be well appreciated in points of in times to come. And therefore, I would say that among all the three vectors that you chose, I would say it is more pro-credible. It's also very credible from the fact that the expectations or the assumptions used in the budget with respect to growth, etc., seem very, very conservative. I mean, for a change, we can say that possibly the market participants think in unanimity that the expectations or the assumptions built in are very, very credible or very conservative, and therefore I think it's a more realism and more a statement of account than anything else.
Right, Harish. I think, that is what probably the market participants didn't like and probably reacted on the day of budget because, there were no big bang reforms. And we've kind of seeing a lot of off-budget, announcements coming in like that we had that of GST. So, and you rightly alluded to the point that, inflation has largely been in control, and it looks like, the monetary policy is largely focused towards inflation control and liquidity management. Whereas if you look at the fiscal policy, it is, kind of targeting at reducing the fiscal deficit and following a very targeted glide path, so to say. So I wanted to understand from you, if you look at both these policies put together, do they look complementary, or it looks like, they are both pulling growth in opposite directions?
No, not really. If you look at in balance, I think this is more a slightly more pro-growth budget than what the past budgets have been. Let me try and peel some layer of the onion as to why I think that's the case. The government obviously during COVID and the pandemic to support all of us and to provide food for the needy and vaccination, etc., ratcheted up a huge deficit. Right, it went up almost close to about 9.5% of GDP, and from there we've been on this glide path. Now, if you look at the extent of the glide path, every year we've been kind of knocking off 60, 80 bips, etc., of the deficit. This year, we've kind of knocked off about 5 bips or 7 bips of the deficit when we think of projecting it forward, right? So, in some sense, what is deficit control? It is about the share of the government in terms of overall economy to come down. Because as a share of the economy, the government kind of increased its size significantly. And over a period of time, they're getting it back to where it was in the past, right? Now, that pace, which is a second order, has been in a particular glide path. That pace is now starting to actually kind of stabilize or kind of reduce that glide path, right? So, in some sense, therefore, the negative drag of the government actually will be lesser as we look into FY27 compared to what we would have seen from FY24 to FY26. So, that's point number one. The second peeling of the layer of onion is if you look at what we call the primary deficit. Okay. Now, just again, this is an economic term, and I hate to use it, the primary deficit is basically any deficit is anything that is beyond what revenues you're getting for, because your expenditure is kind of planned for, that you take it as fiscal deficit, right? Or that's the total headline. But within fiscal deficit, you can break down the interest cost, because the interest cost is not necessarily that you're taking on for debt for today, but the debt that you've accumulated over periods of time for which you're paying that interest cost. So if you remove that part off, what that remainder deficit is called the primary deficit. And that primary deficit, if you look at that glide path, it is now actually at reasonably similar levels to what it was in FY19 before the pandemic. Okay. So in some sense, the extra spending that the government had done has completely wound up, right? And therefore, in some sense, this used to be a negative kind of a impact to the overall economic activity. The government impulse in some sense was negative, and today it has become more positive. So just obviously, while they've kind of focused on being more credible and more conservative, I guess what the market wanted was that, if you're now getting onto this path wherein you are now stabilizing the government share of economic activity, maybe there is a leeway in which you can try and either spend more on revenues, which means more consumption related areas, or you can spend more on capex related areas. And while they've done that, the extent to which they could have done, I guess there was still some more bullets to fire, if they may. If they really wanted to use budget as a platform in which they wanted to unveil a very reform heavy kind of a thing. But as we all agree with the over passage of time, I think that more and more things are being announced outside of the budget. Maybe they wanted that as the point at which they wanted to unveil many of these things. And to your point, actually, the bigger point that you had was whether monetary and fiscal were at odds or were they together. I think the heavy lifting that we expect from the bond market, because the bond market was definitely disappointed with this budget because of the gross market borrowing being higher than what we had thought of, right? And with the strong, supply of paper that has been coming through, especially with the very high duration of long dated paper that was coming through, The heavy lifting is now left to the RBI because they have to now plan how the calendar of borrowing has to be. So in that sense, yes, you can say that it's not been exactly synchronized. But again, these are nuances, we are nitpicking, quite honestly. In the bigger scheme of things, are they like, 180 degrees apart? No, really. But, they're just not completely aligning. Maybe one is at 85 degrees, one is at 95 degrees. So there is some amount of give and take that needs to be done for getting that action.
You did mention that, the nominal GDP growth rate, in your view is conservative, right? So I'd like to understand from you, when you are interacting with the managements of various companies, what signals are you seeing as far as domestic demand, credit growth is concerned? And what impact do you think will global slowdown, if at all, have as far as, our growth numbers are concerned for the, considering from an export-oriented point of view?
Sure, I think a lot has changed overnight as we speak as well, right? But let's look at it from a 18-month time frame because we think it's been a reboot moment caused by various exogenous shocks that have happened, be it geopolitical developments, wars happening across the world, including the one that we had with our neighbor. You also have tariff shocks that have kind of come through, which have kind of increased the uncertainty of trade, right? Now, so in some sense, markets and corporate chiefs have been in a snooze mode, wanting, clarity on many things. Right now, in this 12, 18-month period, if you were to look at it, what we have seen is significant steps that have been taken to kind of catalyze demand. Okay, so let's start with, what are the key things that we've seen in 18 months. Firstly, we started focusing on the domestic consumer a lot more, starting from the last budget, of which we had a detailed discussion last year as well. Followed it up with the GST cuts that came through closer to Diwali. You had the RBI, which went from a macro stability kind of an impulse to something which is more pro growth for the domestic economy as a whole, right? That's point number two. Point number three, we got a rating upgrade thanks to all of the heavy lifting of macro stability that we did through, which would ideally mean that we should have a lower cost of capital compared to what it was before, right? Fourthly, we now have got trade deals with almost 75% of the world economic blocks that are there, right? And these are all very significant points because suddenly you come through a zone wherein you went through a congestion phase of sorts from a policy environment and a macro environment to something where actually building blocks have been laid off, be it in terms of cost of capital, be it in terms of market access, be it in terms of consumer demand. And when you see that in totality, I would think that from a top-down lens, we are headed far higher in terms of economic activity. Right, of course, from a budget point of view, possibly they were or they may not have been aware of the US trade deal. Nobody knows for sure. But the reality is that, we are basically talking about inflation going back from what are 1.5% deflator to something close to about, 2.5, 3%. In a country like ours, which is, generally seen inflation 4, 5%, I think, there is inflation which is good inflation, and then there is inflation which becomes extreme and becomes bad inflation. So effectively, the nominal GDP growth rate that they have been talking about is primarily the inflation coming back into the system, courtesy also that currency has depreciated and which typically tends to import inflation of various counts, right? So therefore, we think that the math behind it from a top-down lens seems really reasonably conservative. Of course, the full extent of what eventually happens, only time will say. And now with this development that has happened, I would say that, we have a very good chance of overshooting this growth assumption which is there.
And you're right, even if you look at the consumption numbers or the contribution of consumption towards GDP, it's been over 60%, which is comforting because that was a big concern till about last year. Right. So now, if you look at the last three budgets, ever since they came back in their third term, manufacturing has been definitely one of the key focus areas. Now, if we ignore intent and look only at macro outcomes, like output share, export competitiveness, or employment elasticity, what has actually changed meaningfully so far?
I think building blocks have been put to get us a higher outcome. Outcomes have not yet translated into what anyone has kind of envisaged with a greater share of output to manufacturing, and it's been a difficult environment, so to speak, right? With the domestic market being in some kind of a stagnancy post COVID. After that initial pent up demand, there has been some amount of wait and watch out there, and the export channel, of course, in the last 18 months going through its own flux. And then on the other hand, you had the most aggressive neighbor, which continues to have its massive amount of capital expenditure on new capacities, flooding the market in whatever shape and form, trying to kind of further depress. So I think it's a combination of all of these that have kind of got us to where we are today. That's the reality. But at the end of the day, I would still like to believe that we are starting to see some meaningful shifts when we speak to management teams. We are now starting to hear a lot more of diversification by companies. Okay, and while of course there is a narrative of how the world political leaders kind of look at it, and that is a very important narrative, and therefore no company is going to come outright and say that we are going to take so much from India, etc. But when you look at various small numbers, we are seeing a meaningful shift. So let's talk of some numbers. Okay. Let's take the case of textiles now with the European Union treaty, and now, of course, yesterday with the US FTA possibly also coming through. Compared to Bangladesh, compared to Vietnam, we seem to have a leg up over there, right? As well as with a depreciated currency, even more competitive compared to what it was before. If I look at, and therefore, when we look at, say, Walmart sourcing from India and what they could have claimed, to double over the course of the next 4 5 years now seems a lot more credible with all of these moving parts out there. Similarly, if you look at Airbus, which over the course of the last few days has come and said that they want to double their sourcing from India. Okay, we're starting to see some very big shifts happening in the aerospace industry, wherein a lot of critical components are now getting shipped out of India. A lot of engineering capacities came through, okay, which kind of got mothballed during this impasse of tariff because the clients were not ready to kind of take in that additional 40 50% of tariffs. Suddenly, you will start seeing a lot of that kind of coming through. So I would say it is always glass half full, glass half empty, but it is still encouraging. And quite honestly, it is not about outcomes. Do we have a choice other than trying this? I don't really think so. So if that is the case, then we have no other option but to double down on the same frontier.
So, Harish, you touched a very important point of diversification of supply chain. In fact, Elon Musk mentioned the same in Tesla's earning call day before yesterday. So, my next question is similar to that. If I look at last 1.5 years, both geopolitics and equity markets, they have been, very focused on a few parts of market, which is semiconductor, rare earth, AI data center, and we saw a lot of discussion around these in the budget also. So, I have two questions around this. One, whatever government announced, are these meaningful measures? And B, how do you see that impacting the growth of India in next decade or so?
Think when you think about all of these new frontiers, the quantum of allocation still is very small. So it is not something that we would think it's going to make a meaningful shift to any of the aspects that we are talking about. But like I say, I think in India it is not about money alone that is the bottleneck. It is sometimes a mindset and sometimes an enabling framework. I mean, the fact that we can send rockets to space at say 100th the cost of even say SpaceX, let alone NASA and all others, does give a sense that we do have capabilities to do it. It is not just about a resource constraint, but many a time it's the prioritization of these capabilities and the enabling framework that needs to come through, that needs to matter. And in that count, I think we've made some strides. The fact that we've got now a fund which is going to focus on innovation a lot more focused on possibly AI, etc. Now again, these are very nebulous terms. At the end of the day, unless we see actual funding happening, etc., we will not really gauge the impact. But see, quite honestly, I don't think that we are not investing in AI because of capital. I really don't think that's the constraint or the binding constraint today. To me, the constraint is okay. Can we have the kind of a talent pool which can embrace it? Can we have risk capital which can look at it from a very long term lens without necessarily asking for a payback in 6 months or 1 year, etc. So it is about animal spirits coming back, and that is requiring a catalyzing of those kind of animal spirits, right? So in that count, yes, are these steps in the right direction? Yes. Is it something that can move meaningfully? The thing I think that lead has to be taken by the private sector. You've got some very well funded corporates now. I think it's about time that they start spending it on AI. Maybe it could be on application layer. It need not be on the lower end. And of course, we did see a very big move from a data center point of view. Wherein quite a lot of this base hardware or the base infrastructure can be deployed and used in.
So, Harish, again, you mentioned another important point, which is about animal spirit. And my next question is around that. So, if we look at public capex for last 5 years, starting with COVID year, it's been gradually inching up, or it's been plateauing, but at a higher level with respect to what is the history of our country, and both as a percentage of GDP as well as a percentage of total expenditure. Now, my question is, balance sheets are good. Government has done its bit in last 4 5 years. Has public capex led to some kind of a cascading effect, or it's still pending and we may need another few years before it start moving into real term productivity?
See, I think private capex, if you were to look at, initially starts with the larger conglomerates. Okay, they account for anywhere between 50 to 55% of total capex on the listed side, and then it starts moving down, right? Invariably, the first capex that people do, they need to see a payback which is very accelerated. Once that gets rewarded, is when the next set of companies will start moving through. Uh, if I were to look at data dispassionately, what I see is actually we are starting to improve on private capex even during this impasse of the last 18 months. Now, why do I say that? We do a basic plot of the number of companies which do a profit of $100 million annually, and then do a set percentage of companies which do a capex of $100 million annually, right? Now, if I were to take you back to the previous big cycle that we saw from 2001 to 2007, because that was the other big capex cycle that we did see, right? From 2001 to about 2005, it might surprise you that the number of companies that reported $100 million profit were far in excess of the number of companies which deployed $100 million in capex. And then it kind of flipped in 2006, 7, 8, and then of course it went on till 10, 11, wherein the number of companies that do capex greater than 100 million almost double the number of companies that actually make $100 million of PAT, right? So that is when animal spirits really start coming through, and capex has got mainstreamed in some sense. Today, when I look at the same data frame from 2001 to 2025, the number of companies which are doing $100 million profits has gone up significantly. Okay, the number of companies which are now doing 100 million capex has almost doubled over the course of the last 3 years. So it is getting mainstreamed, but still the number of companies doing $100 million of profits is more than the number of companies which are doing $100 million capex. My sense is that, with all of these developments that have happened in the last 18 months, I would think that, the time is right for animal spirits to come through. Now, whether it happens, not happens, only time will say. Each cycle is different. But my only point is to frame that, we all think that animal spirits should come just because, the whole world is thinking about it, or balance sheets are good, etc. The reality is that those spirits take time, and therefore there is no way to short circuit that time. And I would think that, over the course of the next 2, 3, 4 years, we will be very pleasantly surprised, is my sense of this animal spirits on private capex.
Understood, Harish. And Harish, now moving to services. So there was a good amount of focus on services, and services has acted as an anchor in India's story for last good number of years. I mean, if we look at the number of GCCs and everything, we have seen good progress on that front. Now, my question is that with this focus on services, are we seeing improvement in employment productivity, improvement in the quality of employment, or these are just consumption stabilizers?
So I think there has been an improvement in productivity, but see, it's all relative, right? I mean, is it the highest level of productivity that a person can do? Absolutely not. But see, we also have to realize that today a portion of the economy, which is maybe 15-16% of the economy, which is agriculture, accounts for almost the lion's share of employment, which means that you've got a hugely unproductive workforce out there, which is only into shadow farming, in the sense that there's no need for so many people to be employed in farming, but because they don't have any other opportunity or they don't have any other thing, they are basically stuck onto farming, right? Now, compared to farming, is construction workers productivity better? Is gig workers productivity better? Absolutely yes. And we are starting to see those shifts happening clearly. Another way to kind of look at the same data set, and again, it's not something about the here and now, but it's always interesting to see within our own, last 10 years, how much change has happened when we look at data from that lens. So again, my numbers may be a bit off, but I'll give you a broad sense of what I'm trying to say. If I look at the total labor pool of wages, in 2013, the largest aggregate wage pool was with the government sector. Right. Next was with the informal sector, which includes wages paid to daily workers, which are all or to our helps and all of that. And then came the private sector. Right. So that was the order of priority. Uh, Sometime in 2021, 22, in these 10 years, what we've seen is that the private sector wage pool has now become larger than the government wage pool. Okay. So order of magnitude, what was number three has become number one in the bigger scheme of things. And then you've got the government wage pool, and then you've got the unorganized wage pool, which is there. So it just gives you a sense that, more and more people are formalizing right in front of our eyes. And with this formalizing, there is possibly a better kind of a safety net in some sense. Obviously, we'll never be having the utopian safety net of, say, the Western world, wherein you get pension and all that. But to a certain extent, is it better than what safety net was there for the previous generation? Absolutely, yes. So I think, we are moving in the right direction. As always with India, it can both delight optimist and pessimist at the same time, and it's again the same setup as it comes to labor.
Harish, adding terms like orange economy and all, do you think it'll have a meaningful impact, or it's just that you're setting the tone for maybe future years?
Yeah, I think it's more setting the tone. I mean, see, our sense is that, the budget speech per se has got a lot of importance because it caters to various constituencies. One is, of course, the domestic voter, more importantly. Then you've got you can say the market participants, which includes us both in the bond as well as on the but it also includes a significant amount of international press and international watchers, be it on the credit ratings and all that, right? And a lot of these tonality is possibly for those also because it kind of sets the agenda from a mind space point of view as to what all are we wanting to gauge from allocations, etc. I think these are all very small from a bigger sense of things.
Absolutely. I think this is a very candid response. So, Harish, now we are towards the end of the discussion. So, two more questions. So, one is about your and my day job. It's about equity market. And on the day of the budget, the entire budget was on one side, and these three alphabets, STT, dominated the market. Though we have seen recovery in the market on a day after the budget, is it that the market overreacted, or STT is going to have a structural impact on how the market shapes up going forward?
No,
And
see,
also, if you could help us understand the impact of this on mutual funds like arbitrage, income plus arbitrage, equity savings funds, those kind of categories.
sure. No, so see, at the end of the day, liquidity has a cost, right? And liquidity channelizes price setting and market expectations quite meaningfully. So it is one cannot be operating in a vacuum because liquidity has its own positives, which is that the depth of the market improves. There is market making happening at finer rates. Otherwise, the bid ask, etc., which we call about, the gap between what somebody is wanting to buy and what somebody else is wanting to sell can widen. And this is impacts on cost of capital for corporates in terms of what kind of companies. Now, this is a theoretical response. The question is how much liquidity is good and how much of it becomes too much. Is a finer nuance that nobody exactly knows that so much liquidity is good, so much beyond that is bad, right? Um, the extent of the growth that we've seen in the derivatives market does give a sense that there has been a reasonable amount of speculative element which is there, and I mean, even before FNO really kicked off post COVID, we used to have the lottery market, for example, in my home state of Kerala. We used to have this bizarre thing that, the lotteries that were sold in Kerala used to be far more than any mutual fund that was getting sold over there, in order of twos and three times. That was the extent of the aspect of get rich quick. And at the end of the day, markets are governed by greed and fear, and you can't do much about it. But when it becomes mainstream and when it becomes very, very large, it has got negative externalities, because then obviously some productive element is being sacrificed for this thing, right? And so, be it in terms of, say, sports betting, or be it in FNO, these have all been things over the course of the last 12, 18 months. We've seen a series of interventions by the regulators out there. Now, STT is, of course, under such element which has come through. Now, the unfortunate or fortunate, the way you want to read it, is that nothing came on the cash market, which itself, in some sense, was kind of good, because you never know that something bad can happen there also. But it was mainly focused on the futures market and lesser on the options market, and in some sense, the futures market, just to be clear, um, the futures market is where institutional players also operate in, including mutual funds, etc. Right? And so, while the options market is typically, I won't say that mutual funds can also operate in, but by and large, it's left to the retail investors and to the prop shops which are there, which is what NSE's data also shows, right? Given a significantly higher impact on futures, in some sense, it has also created some collateral damage for market participants like mutual funds, right? Which is what you're kind of getting to in certain areas where futures is being used quite extensively. So, one of the funds where futures is used very, very extensively is the arbitrage fund, wherein there is zero directional exposure. Everything that we buy in cash, we have to hedge it as far as futures is concerned. And so, essentially, what we are paying for is the spread between the cash which we are owning and the futures, and which typically kind of annualizes over a rate which is higher than the liquid fund plus kind of a broad thing. Because the moment it goes lower than that, then obviously the money from here will evaporate, and when it becomes very large, a lot more money will come through, right? Now, given that this happens on a monthly basis, there is a significant amount of turnover that happens, because every month you have to roll over the futures, etc., to keep getting these spreads, right? So it is our assessment that anywhere between 20 to 30 basis points of arbitrage fund potential returns, if everything else was same, can potentially get impacted because of STT. But the reality is that everything else will not remain the same. So what are the elements that changes to this base case? The first impact that comes through is, whether you're going to see the amount of money which is in arbitrage. So, when, like I said, when too much of money chases arbitrage, the spreads, any which case, kind of come off. And the moment the net return, realized return reduces, this money kind of vacates at the margin, and so a new equilibrium comes through. So, maybe the pool of money itself can kind of change to kind of improve the or offset some of this impact. Okay. The second thing, and which obviously, since today we are in a very excitable day, it's very important, is that markets when they are lackluster and markets when they are exciting have very different set of counterparties. So think of an arbitrage fund which is having something in the cash side, okay, and to hedge that, so that there is no directional exposure, they are selling the futures leg, right? Now somebody else has to buy the futures leg for them to sell it. Now, who are therefore these people who are buying them, right? Now, there are broadly two kinds of players who are buying them. One is the foreigners. Okay, because they typically tend to get very high leverages because international cost is very less, and therefore they can operate a lot more with less capital on the future side. The second is the HNIs or the retail thing, right? Now, when you have a directional view on a particular name, let's say you are privy to some development, or you think that this particular stock over the course of the next 1 month or 2 months can do very well, and then when there is an excitability, you are willing to pay far higher for the futures, because any which case the capital you are consuming is very less, so you're willing to do a lot more. Okay, which means that the spread that you earn as a arbitrage fund manager actually improves. So in phases of exciting markets, exciting means either down or either up, where there's a directional element, you typically start seeing a higher spread. Okay, in lackluster markets wherein there is no real excitement of being in markets, you see these spreads starting to come down, right? Of course, with the developments that we've seen overnight, we do think that we are getting into the phase of excitement, and therefore we think some of these things that can impact because of these STT norms can get obviated by all of these. So, but broadly, this is the understanding. Now, for an arbitrage, almost 65-70% has to be in this futures, and for other hybrids, etc., this number starts becoming lesser and lesser, and therefore, this will be the highest impact. Others will have lesser impacts from a annualized expected return for the end investor.
Understood, Harish, and thank you so much for explaining it in such a detail. So, Harish, my last question, though it was not a part of the original plan for us to ask, but overnight, like you mentioned, there has been a huge development of a free trade agreement with US, and now I think India has 22 or so FTAs with most of the trade blocs or countries. So, if you could give your 2 cents on this, because it's coming at the back of last week's deal with European Union. So, how do you see this panning out?
I think, one of the biggest negatives that we've seen in recent times has been the persistent rupee slide. And that has been courtesy because that from a Indian government point of view, they chose the fiscal resources to move to consumption, courtesy the tax cuts and the GST cuts, etc. Right? But they didn't want to or they didn't want to use those resources to protect the exporter. So therefore, their line of defense to help the exporter has been in terms of weakening the rupee. Now, while therefore that became the channel to help the exporter lobby, this also has a near-term negative impact on foreign owners of equity, because if you're expected to make, say, 10-12% of earnings growth in a particular country and you lose, say, 5-6-7% in currency, you are eventually effectively left with whatever 4-5% of residual returns, which possibly may not even be beating, say, the US treasuries at this point of time, right? And therefore, we saw persistent foreign selling, primarily because of the currency depreciation that was to come through, right? So I think, like I said, the matter of fact is the government very beautifully over the course of the last 18 months have unlevered many such initiatives, focus on domestic, monetary impulse coordination better, rupee depreciation to help the exporters. As you rightly said, multiple trade deals that have happened bilaterally, etc. So and then the rating upgrade also in this milieu. So therefore, when you look at it in totality, we now have think of it like a coil which is a spring which is coiled in. We've done a lot of these things, with the prospect that corporates will now start investing and taking advantage of all of these enabling frameworks, because that is what the government can do to enable an environment where business is conducive. And if businesses start deploying more capex, start earning more profits, I think it's only natural that stock markets will start rewarding. And lastly, because the currency depreciation fears that were there, that kind of puts on a lid. That means that foreigners can now evaluate it, without the fear of massive currency depreciation. So I think this is something that is very welcome. This does reduce the level of uncertainty quite significantly, both on the ground for corporates and as well as for market participants. And therefore, this can potentially lead to a lot higher kind of valuation sustaining over a period of time, provided earnings does come through.
Understood. So positive for exporters, positive for capital market, positive for currency, and maybe positive in terms of flows also. So, Harish, with this, we come to the end of our conversation, and you really helped us a lot in terms of decoding a very complex subject, which is budget. I'll just take our viewers through a few key takeaways before we end this discussion. One is that about the assumption in the budget, and which you very categorically said that these are very conservative and very prudent assumptions. These are not over estimates by the government. Second, you gave a very good example on how primary deficit is at a similar level to pre-COVID level. Then you touched upon how companies are diversifying in terms of their supply chain and a lot of other areas. A very interesting point which you mentioned was that with respect to new age technology, it's not the capital which is a constraint. Maybe it's a talent, maybe the participation from the private enterprises that could be the main reason and not the capital. Then you also helped us understand how private capex is improving because the assumption in the market is whenever we talk to a lot of people around that private capex is still not revived, but you helped us understand that with data. Then you explained how between 2013 and 2023, the largest wage pool, which was government, has now been taken over by private enterprises. And lastly, something which was very educational for us was understanding how arbitrage spreads move and what are the variables which impact beyond STT also, and in what all market scenarios arbitrage spreads are good, and which scenarios are spreads are not good. And lastly, thank you so much for touching upon trade deal as well, because a lot of our viewers would have doubts around that. Thank you so much for taking out time on a busy day, and I'm sure you would have had a very long night as well because the trade deal was announced last night. And really appreciate your commitment and time given to us and our viewers.
Thank you so much. Thank you so much, Harsh. Thank you so much, Mega, for these wonderful questions.